The difference between a loan and a line of credit. Definition of a loan. A loan is a lump sum of money borrowed from a lender, which is typically repaid over time in fixed installments. Loans are used for specific purposes such as buying a car, financing a home, or funding a major expense. The borrower receives the entire loan amount up front and repays it with interest according to a predetermined schedule. Purpose and usage. Loans are suitable for one-time expenses or purchases where a specific amount of funding is needed up front. They provide borrowers with immediate access to funds for large expenses that may not be covered by savings or current income. Repayment structure. Loans have a structured repayment plan, usually monthly, that includes both principal and interest. The terms of the loan, including the interest rate, repayment period, and monthly installment amount, are agreed upon at the time of borrowing. Interest rates. Interest rates for loans can be fixed or variable, depending on the type of loan and lender. Fixed-rate loans maintain the same interest rate throughout the repayment period, offering predictable monthly payments. Variable-rate loans may fluctuate based on market conditions, potentially affecting monthly payments. Secured versus unsecured loans. Loans can be secured or unsecured. Secured loans require collateral, such as a home or vehicle, to secure the loan amount. Unsecured loans do not require collateral but may have higher interest rates to compensate for the increased risk to the lender. Definition of a line of credit. A line of credit, LOC, is a flexible borrowing arrangement that allows borrowers to access funds up to a predetermined credit limit. Unlike a loan, where the entire amount is disbursed upfront, a line of credit offers revolving access to funds that can be borrowed, repaid, and borrowed again as needed. Purpose and flexibility. Lines of credit are often used for ongoing expenses, emergencies, or to manage cash flow fluctuations. They provide borrowers with flexibility to access funds as needed up to the approved credit limit without taking out multiple loans. Repayment structure. Payments on a line of credit are typically based on the outstanding balance. Borrowers can choose to repay the full balance or make minimum payments, which include interest charges. The repayment terms vary depending on the lender and the type of line of credit. Interest rates. Interest rates for lines of credit can be variable, tied to an index such as the prime rate, or fixed for a specified period. Borrowers pay interest only on the amount borrowed, not on the entire credit limit, which can make lines of credit cost-effective for short-term borrowing needs. Conclusion. In conclusion, loans and lines of credit serve different financial needs based on their structure, repayment terms, and flexibility. Loans provide a lump sum upfront with fixed repayment terms, ideal for specific purchases or expenses. Lines of credit offer revolving access to funds up to a predetermined limit, allowing borrowers to manage ongoing expenses and cash flow fluctuations effectively.